Well, this isn't scary, but maybe for some, because tomorrow is the 9-year anniversary of the longest bull market run in history. Will there be another candle on Wall Street's cake next year is the question. Can this continue? Jonathan Hoenig is hedge fund manager at capitalistpig.com, and he joins us now. Good morning.
Great to be with you, Lauren. Yes, yes, it can continue. Just yesterday, new more 52-week highs and 52-week lows. Look, the bull market is continuing, but I think it's not only cause for celebration, but also some cause for concern. It's been 9 years, Lauren, to your point, and the cheap money we've talked about is ending. Some of the technology leadership that's led the bull market seems to be faltering. So, though it's great that the bull market is on, I think now more than ever there's some opportunity for investors to either take some profits or at least build some ballast for when the bad times come.
We're showing a full screen next to you as you speak, Jonathan, showing that since March 9th, the S&P, which your 401k likely tracks, is up 318%. So many investors have made money in the past few years. What storm clouds, and there are many, pick your poison, but what poison do you think can derail the stock market?
Well, one of the biggest worrisome signs, ironically, Lauren, is the confidence. You talked about consumer confidence is at, in many cases, all-time highs, unemployment all-time lows. And look how the average investor has changed his or her attitude since that 2009 low. I remember it very well. People didn't want anything to do with stocks or debt. Now we're seeing some of that behavior begin to change. People taking on more credit card debt, taking more risk. For my money, keep your eye on those FANG stocks, on the Teslas, which we talked about earlier, on the Netflix, on the Amazon. These were the drivers moving the bull market higher, and Apple seems to be the only one really holding on to its strength right now. So if you want the best harbinger of what's to come, keep your eye on the tech stocks. It hasn't been steel, it hasn't been materials that's been leading the market, it's been tech.
Jonathan, you're not concerned that there's such a heavy concentration? We're going to pull up a screen that Cheryl used yesterday. We call it the Party of Five. It's Amazon, it's Apple, as you note, Microsoft, Netflix, and Alphabet. And the investors have such a heavy concentration in these particular names, so there's a lack of breadth in the market, even a lack of breadth in technology. You're not concerned about that?
No, I think you should be concerned. In fact, I remember very well from the later stages of the 2000 bull market, by the time you got to 1999, 2000, it was just a few stocks. Back then it was Cisco, Sun Microsystems, and Oracle and the like. It's different this time in that the names are different, but your point exactly. That's why I don't think investors should just sell all willy-nilly, but at the very least, get that, Lauren, get that emergency fund that we always talk about. Get that 3 to 6 months worth of living expenses on the sidelines, because it's not if the bad times will come. They will. They always do. It's a matter of when. So get your house in order now when the market and the economy are strong so that you can take shelter once the worst times come.
Jonathan Hoenig, we appreciate you.
Thank you.